video, we revealed 100 ways investors lose money, mistakes that quietly erode wealth. But avoiding loss isn't the same as building success. This isn't just the reverse list. It's a blueprint, the winning habits, strategies, and mindsets used by legends like Warren Buffett, Peter Lynch, and Charlie Munger. If 100 Ways to Lose showed you what not to do, this shows you exactly how to win, how to think long-term, act with confidence in chaos, and build lasting wealth. These 100 smart ways are organized into 9 proven categories, from mindset to execution, designed to help you invest with clarity, discipline, and purpose. Whether you're a beginner or experienced investor, this is your next step. Watch both videos. One shows you the dangers. This one shows you the path. Let's dive into 100 smart ways to win in the stock market.
To make these 100 smart, proven ways easy to follow and apply, we've grouped them into 9 powerful categories. The same structure we used in 100 Ways to Lose. Each one covers a critical piece of successful investing: mindset, research, planning, execution, management, tools, discipline, bias awareness, and external awareness. We'll walk through key items in each category, one by one,
with practical takeaways you can apply immediately.
Category 1: Winning Mindset and Psychology. The most important quality for an investor is temperament, not intellect. Warren Buffett. Let's begin with the foundation of all successful investing: your mindset. 1. Think long-term. Great investors don't chase stocks, they buy businesses. The real magic of compounding happens over decades, not days. 2. Stay rational when others panic. Be fearful when others are greedy, and greedy when others are fearful. Buffett. Market chaos is where disciplined investors make their best moves. 3. Detach emotion from investing. Hope, fear, ego, these are your worst trading partners. Logic, data, and patience win over drama every time. 4. Adopt a growth mindset. Charlie Munger says, "Go to bed smarter than when you woke up." If you keep learning, the market becomes your teacher, not your enemy. 5. Avoid herd mentality. Buffett reminds us, if you're not willing to own a stock for 10 years, don't buy it for 10 minutes. Following the crowd may feel safe, but it rarely leads to success. 6. Learn from losses without shame. Every pro investor has losses. What separates them is what they learn. Mistakes aren't fatal, they're tuition. 7. Stay humble in victory. Success breeds arrogance unless you fight it. In the market, pride often comes before a costly fall. 8. Invest with purpose, not for thrills. This isn't a game or a slot machine. You're building wealth, not chasing excitement. 9. Understand risk before seeking reward. Risk comes from not knowing what you're doing. Buffett. Never reach for returns without protecting the downside. 10. Be comfortable doing nothing. Some of your best trades are the ones you don't make. Patience is a profit multiplier. 11. Develop mental resilience. Markets will test your nerves. The question isn't if it gets hard, it's how well you respond when it does. 12. Master your own psychology. Buffett and Munger both say, temperament beats IQ. Because in the stock market, your biggest threat is often yourself. Category 2: Research and Understanding. Know what you own, and know why you own it. Peter Lynch. Winning in the stock market doesn't begin with a hot tip. It begins with deep understanding. This category is all about doing your homework, the way great investors like Peter Lynch and Warren Buffett do it. 13. Invest only in what you understand. Lynch famously avoided companies he couldn't explain to a 10-year-old. If you don't understand the business, don't buy the stock. 14. Study financial statements. The income statement, balance sheet, and cash flow report are the heartbeats of a business. Learn to read them, and you'll see what others miss. 15. Read annual reports, not headlines. Warren Buffett reads hundreds of pages a day. Why? Because headlines distract, while reports inform. 16. Understand the business, not just the ticker. What does the company do? Who are its customers? How does it stay profitable? You're not buying a symbol, you're buying a system. 17. Research the management team. Buffett says, I bet on jockeys, not just horses. Trustworthy, competent leadership makes all the difference. 18. Use 10KS and 10QS, not just articles. Real insight comes from SEC filings, not social media. Get your information from the source. 19. Track revenue, margins, and debt over time. One good quarter doesn't make a trend. Look for consistent progress or warning signs. 20. Check insider buying and ownership. When executives put their own money into the company, they're backing up their words with action. 21. Compare against competitors and the industry. A great company in a terrible sector may struggle. Always zoom out to see how your pick stacks up. 22. Understand macro trends and sector cycles. Rising interest rates, inflation, regulation, all of it matters. Smart investors connect the dots between the big picture and the business. 23. Use tools like Morningstar and FinViz wisely. These are starting points, not decision makers. Use them to sharpen your questions, not to skip the work. 24. Keep a research journal. Write down why you bought each stock. Revisit it when markets shake. Your memory is flawed, your notes are not. Remember, knowledge builds conviction. Conviction builds wealth. Research isn't optional, it's your edge. Category 3. Planning and strategy. The essence of investment management is the management of risks, not the management of returns. Benjamin Graham. A solid plan doesn't guarantee success. But no plan? That's a guaranteed mess. Great investors don't guess their way through the markets, they build a framework, and they stick to it. 25. Create a written investment plan. Before you buy a single stock, write down your strategy. What are your goals? How much risk can you handle? Your plan is your compass when emotions run high. 26. Set clear financial goals. Are you investing for retirement? Your kids' college? Early freedom? A clear why makes your how more powerful. 27. Know your time horizon. The longer you stay invested, the more volatility you can absorb and the greater your opportunity to grow. 28. Diversify, but don't overdo it. Munger called excessive diversification diversification. Spread your risk, but not your attention. Quality beats quantity. 29. Define exit rules before you buy. Don't wait until panic sets in. Know ahead of time. What would make you sell? A broken thesis? A better opportunity? Write it down. 30. Use dollar cost averaging. Investing the same amount regularly helps you avoid bad timing and builds wealth steadily, no crystal ball required. 31. Prioritize total return. Dividends, reinvestments, and long-term growth all matter. Don't fixate on the stock price alone. 32. Rebalance your portfolio periodically. Winners can take over your portfolio. Rebalancing keeps your risk in check and your plan intact. 33. Match your strategy to your risk tolerance. If downturns shake your confidence, you're investing too aggressively. Buffett says, temperament is more important than IQ. 34. Separate core and speculative holdings. Don't let one moonshot crash your entire plan. Define what's foundational and what's experimental. 35. Focus on the process, not just the outcome. Even great decisions can have poor short-term results. Stick to your process. Over time, discipline beats luck. Strategy isn't just for Wall Street, it's for every investor. Build one. Follow it. Refine it. Because in the stock market, planning is power. Category 4. Timing and execution. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Timing won't make you rich. But poor execution? That can make you poor. In the stock market, how you buy is just as important as what you buy. 36. Don't try to time the market. Even the pros can't predict short-term moves. Instead of chasing tops and bottoms, focus on staying invested in great businesses over time. 37. Scale in and out gradually. Buy in pieces. Build your position over time and reduce exposure the same way. Avoid going all in or all out on emotion. 38. Wait for your pitch. Warren Buffett calls investing a no-called strike game. That means you can wait days, months, until the perfect opportunity comes. Be patient. Be selective. 39. Buy during corrections, not euphoria. Peter Lynch made his best picks when others were panicking. Don't chase hype, seek value when prices dip. 40. Use limit orders for precision. Set your ideal buy price and wait. Don't let market volatility or emotion force a bad deal. 41. Watch volume, trends, and support levels. You don't need to be a technical expert. But basic chart awareness can help you avoid buying too high or selling too soon. 42. Let your winners run. Lynch's top gains came from holding strong stocks for years. Don't sell a winner just because it's gone up, sell when the story changes. 43. Avoid buying during hype peaks. If the crowd is screaming buy, it might be time to wait. FOMO is not a strategy. 44. Use earnings volatility to your advantage. Strong companies sometimes drop after earnings because of short-term headlines. These dips are often buying opportunities, not red flags. 45. Respect timing, but don't obsess over it. Perfect timing is rare. Smart execution, backed by research and discipline, is enough to win. 46. Understand seasonality and market cycles. Retail, energy, tech, they each have seasons. Learn the rhythms of the market to align with, not fight, its flow. Winning isn't about buying at the bottom and selling at the top. It's about buying well and executing even better. Strategy wins. Patience pays. Let the market work for you. Category 5. Financial wisdom and capital management. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. Warren Buffett. Building wealth isn't just about picking winners. It's about managing your money like a pro. Smart capital management protects your downside, boosts compounding, and gives you staying power in every market. 47. Invest only with surplus capital. Never risk the money you need for rent, groceries, or emergencies. Invest only what you can afford to leave untouched and unpanicked. 48. Maintain a separate emergency fund. Keep at least 3 to 6 months of living expenses in cash. That cushion lets you ride out storms without touching your portfolio. 49. Avoid margin unless you're an expert. Leverage magnifies both wins and losses. As Charlie Munger warns, borrowed money plus stupidity gets you into trouble. 50. Reinvest dividends automatically. Let your dividends buy more shares. This small habit turns into massive gains through compounding. 51. Track your cost basis and performance. Know what you paid. It helps you make rational sell decisions and plan for taxes. 52. Use tax-advantaged accounts first. Roth IRAs, 401(k)s, and HSAs let you grow wealth with fewer tax burdens. Start here, before any brokerage account. 53. Avoid high-fee funds and advisors. Buffett recommends index funds for a reason. Even a 1% annual fee can eat 6 figures over your lifetime. 54. Plan for taxes before you sell. Holding for over a year can cut your tax bill dramatically. Don't trigger short-term capital gains without good reason. 55. Limit portfolio turnover. Too much trading equals too much tax, slippage, and regret. Fewer moves, smarter moves. 56. Don't chase high dividend yields blindly. A 10% yield might hide a broken business model. Always check payout ratios, earnings trends, and cash flow. 57. Understand price versus value. Just because a stock is cheap doesn't mean it's a bargain. Buffett reminds us, price is what you pay. Value is what you get. Capital management isn't flashy, but it's what separates real investors from lucky gamblers. Protect your downside, reinvest with discipline, and let time do the rest. Category 6: Smart use of tools and resources. What gets measured gets managed. Peter Drucker. Smart investors don't need fancy tools, they need the right tools, used wisely. This category is about leveraging modern resources to gain clarity, not complexity. 58. Use stock screeners thoughtfully. Start with fundamentals like debt ratios, return on capital, and earnings growth. But remember, screeners highlight possibilities, not promises. 59. Build and maintain a watch list. Great investors act when stocks hit their zone, not when they trend. Watch lists keep your best ideas ready for action. 60. Use spreadsheets or portfolio apps. Track your cost basis, position sizes, and allocation. Data-driven decisions beat gut feelings every time. 61. Read investor letters for deep insight. Warren Buffett's letters, Howard Marks' memos, these are blueprints of wisdom. They teach timeless principles in plain English. 62. Watch full earnings calls, not just headlines. Listen for how confident or defensive leaders sound. You'll often hear the truth between the lines. 63. Use ETFs strategically. Want exposure to semiconductors or energy, but unsure which stock? A low-cost ETF can give you the whole basket, without betting it all on one egg. 64. Study what's inside your ETFs. Don't assume all ETFs are equal. The top 10 holdings often drive most of the results, know what you're really buying. 65. Set price alerts and automation triggers. Don't glue yourself to screens. Let alerts tell you when it's time to act, then walk away and live your life. 66. Simplify your toolkit. You don't need a Bloomberg terminal. A few well-chosen tools, used with discipline, beat a cluttered dashboard every time. 67. Understand key financial ratios. PE, PG, ROE, FCF yield. Learn the language of valuation. Numbers don't lie when you know how to listen. Tools don't make you a great investor. But the right tools, used with wisdom. That's a winning edge you control. Category 7: Discipline and habits. The chains of habit are too light to be felt until they are too heavy to be broken. Warren Buffett. 68. Review your portfolio quarterly, not daily. Frequent monitoring fuels overreaction. Let your strategy breathe and do its job. 69. Stick to your plan, especially in volatile times. Peter Lynch didn't flinch during headlines. Winners hold through fear, not flee from it. 70. Keep a journal of every trade and decision. Your past behavior is your best teacher. Log your reasoning, you'll see patterns worth learning from. 71. Automate contributions to build consistency. Investing should become a default behavior, not a daily decision. 72. Focus on companies you own or plan to own. Limit your attention to what matters. Clarity beats overload. 73. Avoid revenge trading after losses. Don't throw good money after bad. Desperation leads to poor decisions. 74. Follow a weekly investing routine. Set aside time to read, reflect, check earnings, and assess your watch list. Treat investing like running a business. 75. Revisit your investment thesis before you sell. Did the business change or did your mood? Sell on broken fundamentals, not broken nerves. 76. Take profits strategically, not emotionally. Trim on strength. Don't hit sell just because it feels high. 77. Read and reflect regularly. Warren Buffett reads 5 to 6 hours a day. Compound your wisdom like you compound your money. Category 8: Behavioral strengths and bias awareness. A lot of people with high IQs are terrible investors because they've got terrible temperaments. Charlie Munger. When it comes to investing, your biggest enemy isn't the market, it's often your own brain. 78. Be aware of confirmation bias. Charlie Munger constantly sought opinions that challenged his views. You should too. Don't just seek comfort, seek truth. 79. Avoid anchoring to past prices. Just because a stock fell from $100 to $50 doesn't mean it's a deal. Ask, is it worth $50 today? 80. Don't chase FOMO. Buying because everyone else is often leads to regret. If it feels urgent, it's probably not wise. 81. Recognize hindsight bias. Thinking I knew it all along blinds you to future uncertainty. Stay humble. 82. Routinely challenge your assumptions. Ask yourself, what would prove me wrong? Wisdom is built through questioning, not certainty. 83. Don't hold losers just to avoid emotional pain. Loss aversion is real but dangerous. If the reason you bought no longer holds, let it go. 84. Learn to delay gratification. Compounding rewards the patient. Time in the market outperforms flashes of brilliance. 85. Admit mistakes quickly and move on. Even Warren Buffett admits errors publicly. Smart investors adjust early, not late. 86. Don't let ego run your portfolio. The market doesn't care how smart you are. Focus on making money, not proving yourself right. 87. Avoid analysis paralysis. Perfect information doesn't exist. Good decisions with incomplete data often beat no decisions at all. 88. Stay intellectually humble. Munger says the best investors are learning machines. Never stop improving. Category 9. External awareness and environment. You don't need to predict the rain, but you should build an ark. Warren Buffett. 89. Understand macroeconomic trends. Interest rates, inflation, GDP, and debt cycles shape the investing landscape. They don't dictate every move, but they influence the tides. 90. Watch the Federal Reserve's tone and trajectory. The Fed doesn't just move interest rates, it moves markets. Pay attention to what they say and how they say it. 91. Track sector and industry cycles. Technology, energy, healthcare, they each rise and fall at different times. Timing matters more across sectors than within them. 92. Follow megatrends, not just headlines. Demographics, automation, AI, climate innovation, long-term trends reveal long-term opportunities. 93. Don't overreact to geopolitical drama. Elections, wars, or political headlines can trigger volatility, but often only short-term. Keep your long-term view. 94. Tune out sensational media. Financial media profits from your anxiety. Stay informed, but not addicted. 95. Don't copy friends, forums, or influencers blindly. Your goals, timeline, and risk tolerance are unique. What works for them might break you. 96. Beware of fake gurus and promoters. As Munger said, if it sounds too good to be true, it usually is. Steer clear of shortcuts and schemes. 97. Observe real-world clues for investment ideas. Peter Lynch looked in malls, parking lots, and everyday life to spot winners before Wall Street noticed. 98. Curate a clean information diet. Choose signal over noise. A few reliable sources beat a flood of distractions. 99. Make independent, researched decisions. The buck stops with you. Don't outsource conviction. Own your moves. 100. Respect the market's power. It's smarter, faster, and more humbling than most realize. Approach it with seriousness, not arrogance. We've explored 100 smart ways to win in the stock market. From mindset and research to execution and discipline. At their core, these principles mean one thing. Think long-term, act with clarity, and base your moves on facts, not fear. Will every one of them work every time? No, markets are unpredictable. But the more of them you follow, the better your odds of lasting success. And if everyone followed them? You could still win. Because success comes from how you apply them. Especially when others hesitate. Use these not as rigid rules, but as tools to make your own. Do that, and you'll be far ahead of most investors. Now go turn smart habits into real wealth.
Thanks for watching. If you found this video helpful, don't forget to like and drop a comment below. We'd love to hear from you. Subscribe for more insights on investing smart, growing wealth, living wisely, and walking with purpose. See you in the next video.